And as Parag introduced, we've learned a lot from each other. I've learned a lot with him and Sujal over the last 15, 18 years. And while if I can play all the 3 types of matches in a day, he can do it twice without any perspiration. So Parag, I've learned a lot from you. Thanks. And coming back to the topic now, valuation, importance, and issues, which I would like to call it as challenges rather than leaving it at issues. For an M&A, I would like to broaden rather than saying only restructuring. Let's divide it from what is commonly known as distress to restructuring. We'll call it M&A. In fact, restructuring is also synonymous with internal transactions or internal alignments. While we know for sure now that the regulatory authorities in the country, whether it's the RBI or the tax authorities, are more looking at fair market value. So whether you look at an internal restructuring or an M&A, we will talk about FMV, fair market value, and its implications in all these transactions. So with this, thank you to the Chamber of Tax Consultants for inviting me and sharing I would be happy to share my experiences and take on questions as this. So I've broken up this into 3-4 parts. One is valuation, importance of the valuation, issues, and how do we navigate, how do we manage with this? Because ultimately we need to move forward. So how do we do that? So with this, I would like to start. Are we able to see this or some lights need to go off? It's fine. No, I just wanted to check. It's same like crystal ball gazing. From far off, it's always going to be difficult for valuations. So I wanted to start, before we start as well, what I want to share with you is Deloitte, with whom I have been associated with. We did a survey for a few years back with the private equity industry. And what are the key challenges in a deal? And it could be private equity deal, M&A deal, internal. So what are the things? So what came out, one of the top 3 factors, one of them obviously, and then I heard Vikram, the last concluding statement, that we'll always be in business. So I'm sure, if you see the first is regulatory environment, unstable situations, changes, too many notification, clarification required. So obviously regulatory is one key driver for valuation or a barrier for M&A. The third most important is what do you call as valuations. Do we get the obtain a right valuation for a deal? Now over the years, now this was some 5-7 years back, obviously a lot of things have got streamlined, though not completely, but one element which has remained as it is the valuation mismatch. Are we able to get the valuation? So I'm just trying to lay what's the importance of valuation in any M&A, whether it's private equity or corporate restructuring. As I said, we'll bucket this session into smaller 3 parts. Little bit on valuation and its nuances, just to focus. A little more on why it is important in any deal. Why is it an integral part of a deal? And then the third part is issues and challenges. What are the typical issues that get coming across and how do we settle with that? So valuation, very quickly, economic concept between willing buyer, willing seller to transact. We are not talking about an over-eagerly buyer or a seller who is under some stress or wants to just do a deal for the sake of it, for some satisfying some ego or some achieving something else. So we're talking about a well-informed decision-making process, a technique. Talking about valuation means a procedure and a technique. A lot of people feel it's only a result, but that's not what it is. We're talking about a proper scientific process and approach whereby an experienced and an expert valuer or all professional can use those techniques and processes to come to a more reasonable number, more logical number. That's where the process can be set. Again, coming back to what Bhavesh Bhai said, I do agree with him. Whether it's a mix of science or it's a mix of art. So when we go through this, we'll also talk about where the art piece lies, where the science piece lies. And we're not trying to do something what is arithmetical or a mechanical exercise. Believe me, over the years with Sujal, Parag, and we would have done valuations for hundreds of companies. Every engagement has been challenging, has been interesting, and which is what is keeping us sticking in this field. So other point is, there are different methods of valuation available. Some could be considered as primaries in a particular case, some could be considered as secondary. But they always talk to each other. They're not mutually exclusive. So that's also an important element to be kept in mind. If you look at valuation, I think we'll focus on this slide and then we can talk about it. Are we looking at what type of a deal? Are we looking at a full acquisition, a full transaction of a business, or a minority stake? So that's where some nuances on the premiums and discounts come in play. When are we doing this? Is the valuation date today, or are we doing it 2 months down the line, or are we referring to a deal which happened 5 years back, and can we refer to that? Or can we plainly refer to that? Do we need to make an adjustment? So what I want to drive is, its valuation is on a specific point of time. Around that time, it's not as if it's a phenomena which should be carried forward all the way. Other element is, what is being valued? Are we talking about a company being transacted, a business unit, or an asset, or a liability, or a trademark, or any other intangible? That securing a definition of what the underlying is critical. That's the critical starting point. Are we talking about a going concern scenario, or are we talking about a liquidation scenario in certain cases? In general, we come across what we call as going concern scenario because we're trying to acquire a running business, either as part of a long-term business strategy, or we're trying to divest something which doesn't fit into our core business. So we're talking about what is going concern predominantly. Yes, we have come across situations where liquidation-based valuations also have to be carried out, but predominantly it's the going concern. So that's the usual basis. The most important point in any valuation, irrespective of the type of industry or the level of company or the maturity level of the company, is what it offers to the buyer. If you're looking at from a buyer's perspective, what it offers. It offers a forward-looking cash flows. You may take the benefit of hindsight, a rear view mirror of how the company has performed in the last 50 years, but that may not surely tell you that the next 50 years or even the next 5 years they will be able to perform in the same manner. So you can take the benefit of the past results, past analysis, but a valuation has to focus on what's forward-looking. And again, we're not looking at mechanical arithmetic, so we're not looking at accounting profits. Ultimately, it has to translate into something in my pocket, in your pocket. So it has to be cash flows to them. So two, forward-looking and cash flows. These are the key two. So all put together is what we call as the premises of valuation. What we are trying to value, when we are trying to value, for what percentage stake are we looking at? What is the basis? Are we looking at a dissolution kind of a situation? Or are we looking at something like a going concern? These are the critical pieces. And of course, to evaluate that, there are basic 3 buckets in which you can put the methods of valuation. Asset approach, market approach, income approach, or what is called as earnings approach. We'll go into a little more detail in the next slide. Some more important principles of valuation. Few of them. Why do we need to carry out a business valuation? We already have a historical balance sheet. Does it reflect the true value of it? But no, we invest in fixed asset working capital in a business to generate products, goods, services, to make profits out of it. So what it reflects, or a better reflection of the true value of our investment on the balance sheet, is the earnings potential. So though you may have an asset valuation, though you may have a book value as per the audited accounts, but that may not reflect the true value of the company. True. Second, we are talking about the business valuation. We generally do not talk about asset value because we have created that wherewithal of plant machinery, people, trademarks, intangibles, management, goodwill, etc. as a complete package which can be sold off like a company or a business, which should typically yield a better value than what the investment is. Third is, what are we talking about in a restructuring or an M&A? Are we talking about an internal evaluation where the shareholding or the economic benefit or the control do not lose, or like a typical demerger to a wholly owned subsidiary? There is no leakage in the control, there is no leakage in the value. Or are we talking about a transaction like, let's say, the Reliance transaction of 2005 and the family split and there were multiple entities involved? The set of shareholders could be different. So there the fair valuation played an important role. So there is an important, what you call as a nuance that needs to be looked at is a fair value or an absolute value versus a relative value. So when you embark on a valuation exercise for a particular purpose or a demerger or something like that, we need to focus more on the relative valuation part of it rather than a fair value of it, because you're not disposing of, you are putting from one pocket to another. You still will continue to hold that unless until it's a change in the whole shareholding pattern that requires you to do a fair valuation. And one of the other point to be kept is, it's not about valuation as a single pinpoint number. As we said, it's at a given point of time and it's an opinion from a valuer. So it will always be different from my situation or my way of looking at things with your side, from a buyer's perspective to a seller's perspective. So it's always going to be in this range. Now the range could be far apart in an M&A deal, or it could be very near. If it's too far, then the situation happens that there is no deal. We're talking about completely anti-polar situations. But the situation where the deal happens is a little bit of a common area. Of course, as a buyer or a seller, you would want to maximize your gain, either by way of limiting your outflow or by way of maximizing your sale proceeds. But obviously, if two people keep their own stand as it is, there's no deal, then all the gains that one expects to make is only on paper. The question is, how can common ground be achieved, whereby it's a win-win for both the guys, there is a buyer or a seller. So that's a thin area or an area where the deal can happen. But obviously, as a start, as a posturing, as various other things, you start at a very different numbers, a different approach, a different way of putting about what you think about your valuations or what you think about your business. That brings us to what we were talking about from a buyer's perspective or a seller's perspective. The way you look at it, a promoter will always be very passionate about his business. He will always think his retail store is equal to his Flipkart. But whether that makes sense to the other party, he will be not ready to. He can pick up whatever multiples or whatever the Flipkart multiples or Shopper multiples are coming, and he can say, ideally that should be the minimum that should be applied to me. That needs to be looked at. There are different reasons why a deal happens in Flipkart of a world versus what could possibly happen in our case. So there is a fine difference between a value in a buyer's mind or a seller's mind, or what's the fair market value in a neutral situation versus what a deal can happen. It could be a distressed situation and somebody wants to sell off, or somebody just made a good money out of it. WhatsApp versus Facebook, if you see how the deal happened, there's no benchmark to it still. But if you ask, even the promoters wouldn't have thought about $19 billion as its fair value. So when we talk about valuation, keeping these principles in mind, the perspectives in mind, we call it, yes, there's a lot of subjectivity involved, because of a lot of qualitative factors that have to be kept in. Repeating that it's not a mechanical exercise. So what happens is, it's so-called as informed subjectivity. That's where the expertise and the experience of a valuer helps in reducing those or mitigating those. The other part is, as we said, the deal happens in that gray area. Very quickly touching on the methods of valuation, we can bucket them into asset approach, earnings approach, and market approach. And these are all pervasive, irrespective of the industry, irrespective of the geography. These can be classified as what we call as internationally accepted methods of valuation, whether for a going concern company, whether for a liquidation, whether for an insurance entity or for an online retailer or for a single store company or a private limited company. The only thing is, the art lies in the valuer's mind in terms of which method or the appropriate method is required to be deployed as the primary method in a given situation. And the methods could be completely different for the same industry, within the same industry or for different entities. Because it all depends on the purpose, the maturity level of the company, and where we are looking at doing a transaction. I'm trying to dispose of, I'm trying to acquire. So the methods are all pervasive, are all universal, but the art lies in choosing the right approach. Yes, again, coming back to the statement, it's not like one method is good for one particular industry or for one particular valuation analysis. It needs to be corroborated with other methods of valuation. Else it can be debunked very easily. We're also talking about a lot of things that are happening in intangible space. A lot of restructuring happened where intangibles or IP rights have been transferred globally as part of the global transaction, or transactions are happening where the brands, pharma brands and molecules are being transacted. So for that also there are specific methods of valuation under the earnings approach. Cost may be little less applicable because the cost incurred to develop those molecules or trademarks or registration costs may not reflect the right value for it or the time invested into it. So the relief from royalty or excess earnings method, these are also the other methods of valuation that needs to be considered. Once we've looked at multiple methods of valuation, we will always, as we said, there is going to be a primary method of valuation, there is going to be a corroborative cross-check by other multiple methods of valuation. So you are starting with a range of values under DCF, a range of values under the market approach, a range of values under the transaction approach. So how do we go about it? So that's the important point here in terms of on this slide is, how do you deal with it? Now you started with 6 or 9 values under each of this. Then where it comes to is, what's the purpose for which we started this exercise? Wherein the weightages are? Should we look at a simple mechanical or simple average of it? Or do we need to give more credence and recognition to an earnings approach value rather than what is the book value of assets? So this is where the art, or this is where the experience helps. This is where the distinction comes between somebody who's done a valuation, somebody who's pragmatic, who has looked into this types of businesses and can do this valuation. So again, on the final recognition on this slide is valuation. You need to use your common sense. Are we willing to put our money where one can issue a report, but are you willing to put that much money? Is that a conviction? That's the common sense, that's the reasonableness, that's more important to this. First part is we've dealt with in terms of the valuation, the methods, the principles, defining what are we valuing, where we should. So now the next step is its importance. And we'll talk about, like in the first opening slide as I mentioned, it's one of the top 3 factors which affect an M&A. Now we can go in a little more detail as to at which each step of M&A, how does it affect the valuation, or it plays its own role. The general purpose requirement for a valuation: restructuring of companies, purchase sale, litigation, family settlements, we have fundraising. The second basket has become very important because we've got RBI, we've got tax, we've got other authorities, regulators, but they don't talk to each other. In India, per se, unlike other developed countries, there's no specific definition of FMV or valuation. And if you look at the tax books, they will refer to something else in the section 56 versus what's there in RBI is a fair market value and it's left to the best judgment of the valuer. So still they don't talk to each other. So we need to be mindful of all this when we do this valuation. So again, FEMA, transfer pricing, withholding taxes. What is more important as part of withholding taxes? The new one is indirect transfers. Pursuant to a global transaction, if something is happening here, or a classic case of Vodafone. So this is what it comes here as part of the withholding tax or capital gains valuation. Valuation under SEBI requirements, Companies Act. Intangible, as we said, a lot of action we can see in IPs, trademarks being transacted locally and globally, so outbound as well. Because as pursuant to global, if let's say Pfizer acquired Hospira has an entity in India, and if they were to sell off something, it's pursuant to a global transaction. Indian companies made to transact, made to sell. There are multiple examples of this. Part of it could be in the listed space and part of it is private. But those are the requirements wherein the valuation is coming. So intellectual property, financial reporting. Obviously starting from the bottom, India's going forward will require a fair market valuation. Though accounting has its own certain nuances to a valuation, up to what's the measurement date, how you should look at it, level 1, observable level 1, 2, 3. But still, the principle of valuation remains the same. The timing and the way to apply it or fine tuning is a little different. The other one, last one is private equity, or you can read it as M&A come in where the people with money want to invest. Like a lot of companies have sold their business and now become like a private equity on their own. They've been investing in multiple businesses. Like if you talk about Piramal, after selling off their medical business or pharma business to Abbott, they've saddled with a lot of cash, so they've been doing that as an investment. Fairfax has been investing into different kinds of businesses, right from airport, chemicals, asset management companies. They're into Thomas Cook, they're into so many other businesses. So the way you utilize your business or the balance sheet is different. So they also require valuations. One, at the time of evaluating the targets, entry. Second, financial reporting purposes, like the private equity, funds. Third is subsequent rounds of funding. And fourth is exit, at the time of exit. Important one recently, if you remember last 10-15 days back, there was a news article on ET on the first page, is giving an example. Let's say Flipkart got a valuation of $15 billion in the first round, and subsequent round were happening at $12 billion or $10 billion. Not simple accounting adjustment of impairment, but investments happened in the company which gave a valuation which was lower. So IT department has gone back to those companies and said that no, your fair valuation, the first time you issued it at let's say $15 billion equivalent value per share, why should your second one be lower? And if second is the right fair value at this time, that means under section 56, the difference between the second and the first needs to be taxed as other income. So they are also innovating. So I think what is important here is the way we handle for any of these purposes. We need to be having a robust set of documentation, valuation, internal notings, why a valuation has changed between the two rounds of valuation, why the transactions are deferred, whether the stakes were different, did you sell a majority stake versus minority stake, Was there other requirements? All that needs to be, because typically the scrutiny would have come 2 years down the line. People would not remember or have all the documents in place handy, or people would have gone. So I think these